You probably think oil stops flowing when something blows up. A pipeline gets hit. A tanker gets attacked. A port goes dark under military fire. That's the mental model most people have, and it makes sense. It's what the news shows you. But right now, in March 2026, as the U.S. and Iran are escalating in the Persian Gulf, oil shipments are slowing and prices are climbing. And the reason isn't just military. It's a group of private underwriters sitting in offices in London. No warships, no missiles, just cancellation notices. And somehow, hundreds of vessels are dropping anchor in the Gulf without a single explosion. That mechanism is what this video is about. And once you understand it, you'll never read an oil crisis the same way again. Here's the part they don't explain in most news segments. A tanker carrying millions of barrels of crude oil generally cannot operate commercially without insurance. That's not a suggestion. It's not a best practice. It's a hard requirement built into almost every layer of global shipping. Ports require proof of coverage before they let a vessel dock. Banks financing the cargo require it before they release funds. The charter contract, the legal agreement between the ship owner and whoever hired them, often lists insurance as a condition of the voyage. Without it, a loaded tanker becomes an unacceptable legal and financial liability. One accident, one collision, one oil spill in international waters, and you're looking at billions in potential claims. No rational operator runs that risk uncovered, so they don't. And this is where it gets interesting. Because of that, a small group of private companies control a huge part of global trade. Not governments, not the military, insurance companies. Specifically, the London marine insurance market, centered around Lloyd's of London and its network of syndicates. This market has no elected officials. It answers to no foreign ministry. It's just a collection of private underwriters who look at the world's shipping lanes, assess the risk, and decide whether they'll cover a vessel and at what price. When they say no, ships stop moving. Not because any law forces them to stop, because the economics of sailing uninsured make the voyage impossible. So how does this actually happen? Marine insurers maintain risk maps of the world's shipping lanes. These aren't published on some government website. They're internal assessments, updated constantly as geopolitical conditions change. When things deteriorate in a specific region, underwriters can reclassify those waters as a war risk zone. The moment that happens, the cost of war risk insurance for any vessel transiting the area jumps immediately. Sometimes insurers don't just raise prices, they limit what they cover. Or they start canceling policies for ships already sailing in those waters. That's what Reuters reported in early March 2026. London's marine insurers widened their high-risk designation across the Gulf as the U.S. Iran situation escalated. Premiums surged. Some underwriters refused to quote new policies at all. Others began canceling existing ones. Think about what that means for a shipping company. Your vessel is in Gulf waters. You had coverage. Now you have a cancellation notice. And you need to move a cargo of crude through the Strait of Hormuz. You have three options. Pay whatever the new premium costs. Find an alternative insurer willing to take on the risk. Or drop anchor and wait. Reuters vessel tracking data from March 2026 showed hundreds of ships chose option 3, just sitting there, in the water. Not because the strait was physically blocked, not because someone fired a missile, because the financial infrastructure supporting the voyage had collapsed overnight. No infrastructure was destroyed, traffic slows anyway, oil prices are moving. That's the mechanism. Here's the number that makes all of this feel real. Roughly 1/5 of the world's daily oil supply moves through the Strait of Hormuz. That's around 20 million barrels per day. Oil, liquefied natural gas, all of it funneling through a stretch of water about 21 miles wide at its narrowest point. It's one of the most important routes for energy in the world. Any problem there spreads fast. Insurance costs are a direct input into freight rates. When war risk premiums spike, the cost of physically moving a barrel of oil from the Gulf to its destination goes up. Ship owners pass that cost to traders. Traders price it into the crude they sell. Refineries pay more for the raw material they're processing. Eventually, the increase shows up at the end of the chain. This is why analysts who track energy markets closely watch insurance conditions as closely as they watch military movements. A military action might take weeks to affect physical oil infrastructure. An insurance reclassification can change freight economics overnight. During past periods of elevated tension in the strait, war risk premiums for transiting vessels jumped several times above their normal baseline rates. Some policies also include what are called blocking and trapping clauses, coverage for vessels that get stuck or stranded in a conflict zone, and those carry their own premium costs that spike when tensions rise. In extreme cases, the total cost of insurance and shipping gets so high that the trip just isn't worth it, even before any fighting starts. That's the hidden switch controlling everything. The insurance market effectively sets a minimum cost for transporting oil through dangerous waters. When that floor rises high enough, shipments slow, and the global oil price adjusts to reflect reduced supply. Here's the thing, this pattern has happened before. During World War II, German submarine activity in the Atlantic made transatlantic shipping catastrophically dangerous. Insurance rates for cargo making that crossing the ocean rose as the risk increased. Higher premiums became one of several factors reshaping how shipping routes were organized during the war. The insurance market wasn't causing the war, it was pricing it. And that pricing changed trade flows in ways military planners actively had to work around. Same logic in the 1980s during the tanker wars. Iraq and Iran attacked commercial shipping in the Gulf throughout their 8-year conflict. War risk premiums surged. Coverage became expensive and hard to get. Shipping companies rerouted. Some stopped sailing entirely. Oil markets absorbed the disruption through price adjustments. Different sides, identical mechanism. What's different now is scale and speed. The London marine insurance market plays a larger role in global shipping finance than it did 40 years ago. Global oil markets are more interconnected. When the insurance infrastructure for Gulf shipping tightens, the effects spread farther and faster than it did in the 1980s. The tool is the same, the impact is bigger. Now here's the part most people don't talk about. Insurance companies are private institutions. They answer to shareholders and regulators. But they don't take orders from governments the way military assets or state-owned enterprises do. When a group of London underwriters decides that Gulf waters carry too much risk, they are making a commercial judgment, not a policy decision, not a diplomatic one, just a risk assessment. But the result feels the same as a partial blockade of one of the world's most important oil routes. There's no single international rulebook that dictates how private marine insurers define a war risk zone. No treaty governing when they must maintain or cancel coverage. The boundaries of a high-risk designation are set by private market consensus, and they can change within hours of a major news event. This gives the insurance market a speed and flexibility no government intervention can match. And it gives the people who control that market a form of influence over global trade that operates completely outside most people's mental model of how power works. In March 2026, Al Jazeera and The Guardian both reported that major insurers had issued cancellation notices for war risk coverage in Gulf waters, with some underwriters refusing to quote new policies for the region entirely. The operational consequences showed up in vessel tracking data almost immediately, ships pausing, cargo sitting. Shipping companies are scrambling to find alternative coverage or alternative routes. The financial mechanism amplified the disruption before additional physical infrastructure had to be touched. The current situation in the Gulf follows a pattern that has appeared ahead of every major energy disruption of the past 50 years. The factors change. The financial mechanics stay the same. When the financial infrastructure supporting global trade starts tightening around a specific region, physical trade flows follow. The sequence is always the same. Geopolitical escalation, insurance reclassification, premium spikes and coverage withdrawals, shipping slowdowns, price adjustments in the commodity market. That sequence is playing out right now, and it is happening faster than most energy market commentary recognizes. The three things worth tracking from here are the scope of the high-risk zone, the availability of war risk coverage from the major London syndicates, and the vessel tracking data showing how many ships are anchoring or rerouting. Those three indicators will tell you more about where oil prices are heading than almost any military briefing. Here's the full picture, fast. A tanker without insurance basically cannot legally sail. Ports require it. Banks require it. Charter contracts require it. London's marine insurance market, private and unelected, controls war risk coverage for a massive share of global shipping. When they designate an area as high risk, premiums spike, coverage gets restricted, cancellation notices go out. Ships stop moving, not because of military force, but because the economics of sailing break down overnight. About 20 million barrels of oil per day move through the Strait of Hormuz. Any friction there spreads through freight rates, into crude prices, and all the way to the end of the supply chain. This pattern showed up in World War II in the 1980s tanker wars, and it's happening again right now in 2026. No international treaty controls when insurers can pull coverage. It's a private market consensus, moving at the speed of a news event. The sequence is always escalation, reclassification, premium spike, shipping slowdown, price adjustment. And the three signals to watch are the risk zone boundaries, coverage availability from the London syndicates, and vessel tracking data. The most powerful weapon in an oil disruption isn't always a navy. Sometimes it's a cancellation notice sent from an office in London to a ship sitting in the Gulf that now cannot legally move. That's the war most people never see, and in the global oil market right now, it may already be shaping the outcome.